In this analysis, I want to take you through one of the most misunderstood financial evaluations of Metaplanet's income statement. In FY 2024, Metaplanet reported a net profit of 6.396 billion yen. In FY 2025, it reported a net loss of 95 billion yen. Most investors looked at those two numbers and drew completely opposite conclusions. One year brilliant, the next year catastrophic. They were wrong both times. By the way, I would really appreciate it if you could hit the like and subscribe button on YouTube, as it motivates me to publish more content. Thank you. In FY 2024, that net profit of 6.396 billion yen was not really a measure of the business performing well. It was almost entirely a non-cash Bitcoin valuation gain. The actual operating profit, the income generated by running the business, was just 350 million yen. In FY 2025, that 95 billion yen net loss was not a measure of business failure. It was almost entirely a non-cash Bitcoin write-down, an accounting entry required by Japanese rules. Meanwhile, the actual operating profit surged 1,697% to 6.29 billion yen. Revenue grew 738% to 8.9 billion yen. The business had never been stronger. The number that actually tells the real story, operating profit, went from 300 million and to 6.29 billion yen in a single year, and management has now guided to 11.4 billion yen in operating profit for FY 2026. This article asks the question almost nobody is asking. If Metaplanet hits that target, what does it unlock? The answer is a preferred share engine, the Mars program, capable of funding billions of yen in non-dilutive Bitcoin purchases, permanently growing Bitcoin per share without issuing a single new common share. One important note upfront. Mars preferred shares have been announced but not yet publicly issued. Everything I walk through today is a framework analysis of what becomes possible when they are. This is the blueprint. Execution is what comes next. The first thing any analyst needs to understand about Metaplanet is that it effectively runs two profit and loss statements simultaneously. One reflects the actual business, the other reflects the accounting treatment of its Bitcoin holdings. They tell completely different stories, and confusing them is the most common mistake made in evaluating this company. Here is the accounting rule at the heart of this. Under Japanese GAAP evaluations, the standard Metaplanet follows. Bitcoin holdings must be marked to market at the end of every quarter. This means if Bitcoin's price falls between one quarter end and the next, the decline in value is recorded as a loss on the income statement. If Bitcoin's price rises, it is recorded as a gain. These entries are entirely non-cash. No Bitcoin is sold, no money changes hands. The business operations are completely unaffected. But the profit and loss statement swings dramatically based purely on where Bitcoin's price happens to sit on the last day of each reporting period. The result is a net income figure that is almost meaningless as a measure of business performance. In good Bitcoin years, net income flatters the business. In bad Bitcoin years, net income destroys it. In neither case does it tell you what the operating engine is actually producing. Let me show you how this played out across 2 years, FY 2024 and FY 2025, which are perfect mirror images of each other. In FY 2024, Operating profit was 350 million yen. Net income was positive 6.396 billion yen. That is 18 times operating profit. The business had just launched its Bitcoin income generation strategy in the fourth quarter of 2024, barely one full quarter of operation. Yet on paper, it looked enormously profitable because Bitcoin's price rose sharply and created a 5.4 billion yen valuation gain. In FY 2025, operating profit grew nearly 18-fold to 6.29 billion yen. One of the most remarkable operating performances in Japanese corporate history for a company this size. Yet on paper, it looked catastrophic. A 95 billion yen net loss because Bitcoin's price declined from near its all-time high and created a 102.2 billion yen write-down. The analogy I find most useful: imagine a property developer whose portfolio fluctuates in value each quarter. Their net worth swings wildly with property prices, but their management fee income, the actual business, grows steadily regardless. Metaplanet's operating profit is the management fee. The Bitcoin valuation movement is the portfolio fluctuation. One tells you about the business, the other tells you about Bitcoin. Here is the full picture from FY 2024 through to the FY 2026 target. Bitcoin income generation, revenue, 691 million yen in FY 2024, 7.98 billion yen in FY 2025, and a target of 16 billion yen in FY 2026. Operating profit, 350 million yen, 6.29 billion yen, and an 11.4 billion yen target. Net income, up 6.396 billion in FY 2024, down 95 billion in FY 2025, and unknowable in FY 2026 because it depends entirely on where Bitcoin's price sits on December 31st. The operating profit line is the only one that tells a coherent, uninterrupted story: 350 million to 6.29 billion to an 11.4 billion target. That is the story of a business being built at remarkable speed. Everything else is Bitcoin price noise. For the rest of this presentation, we will focus exclusively on operating profit. It is the only number that matters for preferred share capacity, dividend sustainability, and long-term Bitcoin accumulation strategy. The engine behind Metaplanet's operating profit is the Bitcoin income generation business, known internally as BIG. Launched in Q4 2024, it generated 691 million yen in its first partial year, scaled to 7.98 billion yen in FY 2025, and is now targeting 16 billion yen in FY 2026. Understanding exactly how it works, mechanically, financially, and from an accounting perspective, is essential context for everything else in this presentation. The strategy, in plain English: Metaplanet sells cash-secured Bitcoin put options from a dedicated capital pool. This pool is entirely separate from its long-term cold storage Bitcoin holdings. The cold storage Bitcoin is never touched. When Metaplanet sells a put option, a buyer pays them a premium upfront in exchange for the right to sell Bitcoin to Metaplanet at a predetermined price on a future date. That predetermined price is called the strike price. Metaplanet sets aside cash collateral equal to the strike price to guarantee they can fulfill the obligation if needed. There are only two possible outcomes. Outcome 1: Bitcoin stays above the strike price. The option expires worthless. The buyer does not exercise. Metaplanet keeps the full premium as income. The collateral is released and the cycle repeats. Outcome 2: Bitcoin falls below the strike price. The option is exercised. Metaplanet uses the collateral to buy Bitcoin at the predetermined strike price. They now hold more Bitcoin, purchased at a price they agreed to in advance. Here is the analogy that makes this click. Imagine agreeing to buy Bitcoin at 80,000 US dollars 6 months from now and being paid $4,000 today just for making that commitment. If Bitcoin stays above $80,000, you keep the $4,000 and the deal ends. If Bitcoin falls below $80,000, you buy it at $80,000, which is exactly what you wanted anyway. Either outcome works in your favor. This is not speculation. It is structured income generation with Bitcoin accumulation as the alternative outcome. Now, how does this hit the profit and loss statement? This is one of the most important accounting nuances, and it is worth being precise. Under ASBJ Statement Number 10, Japan's accounting standard for financial instruments, Metaplanet's put options are classified as trading derivatives. This has a specific consequence. Option premiums are recognized as operating revenue immediately upon receipt. They are not deferred until the option expires or is exercised. Simultaneously, all open positions are marked to fair value at each period end. Unrealized gains and losses on open positions also flow through the big revenue line. In practical terms, big revenue in any given quarter equals cash premiums collected in the period plus or minus the mark-to-market movement of open positions at quarter end. One important nuance: in a quarter where Bitcoin falls sharply, open put positions move in the money and their mark-to-market value rises, creating a reported loss within the big revenue line, even while cash premiums continue arriving. The cash is real and immediate. The mark-to-market loss is a reporting artifact on an open position that may fully reverse the following quarter if Bitcoin recovers. This is why annual BIG revenue figures are a cleaner representation of the strategy's true earning power than individual quarterly figures. Here is what the confirmed collateral and yield data shows. In Q1 2025, approximately 9.386 billion yen deployed as collateral, generating 770 million yen in quarterly revenue. That implies an annualized yield of approximately 33%. In Q 2025, approximately 20.412 billion yen deployed, generating 1.1 billion yen in the quarter, approximately 37% annualized. Q3 2025 produced 2.4 billion yen in revenue. Q4 2025 produced 4.2 billion yen, and in Q1 2026, a further 6.3 billion yen of collateral was earmarked, producing 2.9 billion yen in the quarter. The implied annualized yield of 33 to 37% is not unreasonable. Bitcoin's implied volatility ran between 60 and 80% annualized during this period. Institutional practitioners who run systematic Bitcoin put writing strategies report annualized yields of 20 to 40% as realistic in elevated volatility regimes. Metaplanet's performance sits within that range. Now, can Metaplanet reach its 16 billion yen revenue target for 2026? Working backwards, 16 billion yen target revenue divided by approximately 35% annualized yield requires approximately 45.7 billion yen of average deployed collateral during the year. The estimated current collateral base is approximately 25 to 35 billion yen. So there is a gap of approximately 10 to 20 billion yen of additional collateral required. There are three pathways to close that gap. First, new equity raises, with 5% allocated to big collateral. A 200 to 400 billion yen raise adds 10 to 20 billion yen directly to the collateral pool. Second, allocating more Bitcoin holdings as collateral from long-term reserves, which would easily cover the shortfall. Third, management increasing the big allocation rate above 5% as the strategy's track record matures. I think the 16 billion yen target is achievable. The single biggest risk is Bitcoin implied volatility compression, which I will cover in the risks section, but the pathways to get there are clear. One final check on the numbers. Is the 11.4 billion yen operating profit target internally consistent with 16 billion yen in revenue? FY 2025's operating margin was approximately 70.7%, 6.29 billion divided by 8.9 billion. BIG's cost structure is largely fixed, a small options desk team, technology, and compliance. As revenue scales, margins should improve, not compress. At 71% margin applied to 16 billion yen in revenue, 11.36 billion yen in operating profit, essentially exactly the target. The two numbers are internally consistent, and critically, Project Nova contributes zero operating profit in 2026. It is pre-revenue. All 11.4 billion yen must come from BIG. There is no Nova cushion in 2026. This section introduces the Mars framework, but I want to state this clearly upfront. Mars preferred shares have been announced but not yet publicly issued. What follows is a framework analysis of what becomes possible when they are. This is why the FY 2026 operating profit target matters so much. It is the direct determinant of how much preferred share capital Metaplanet can sustainably issue. Two rules must be satisfied simultaneously at all times. Both are binding in different scenarios. Understanding how they interact is the key to understanding Metaplanet's capital allocation strategy. Rule 1 is the balance sheet constraint, the 4-to-1 ratio. Management policy: total preferred shares plus debt outstanding must not exceed 25% of Bitcoin holdings by market value. Put another way, Bitcoin holdings must always be worth at least 4 times the total preferred shares outstanding. The formula: maximum preferred shares outstanding equals Bitcoin holdings market value divided by 4. Metaplanet currently holds 40,177 Bitcoin as of May 19th, 2026. At approximately 12.2 million yen per Bitcoin, that is a total Bitcoin market value of approximately 500 billion yen. Current 4-to-1 ceiling: 500 billion yen divided by 4 equals 125 billion yen. This ceiling rises automatically as Bitcoin's price appreciates or more BTC is accumulated. Every Bitcoin purchased directly expands future preferred share capacity. That compounding effect makes Bitcoin accumulation self-reinforcing. Rule 2 is the cash flow constraint, dividend coverage at 1 times. Mars preferred shares carry an upper limit of 8% annual dividend. Under Japan's Companies Act, dividends must be paid from distributable net profit, not from unrealized Bitcoin gains, not from paper appreciation, not from capital reserves. Only realized operating earnings qualify. Management has indicated that operating profit serves as the gauge for how much preferred shares can be issued. Effectively, a 1 times coverage ratio, meaning operating profit sets the direct ceiling on sustainable annual dividend obligations. Here is how that plays out across different operating profit levels after applying 30% Japanese corporate tax. At FY 2024's actual operating profit of 350 million yen, maximum mass outstanding of just 3.1 billion yen, barely enough to matter. At FY 2025's actual operating profit of 6.29 billion yen, maximum mass outstanding of 55.1 billion yen, already a significant number. At the FY 2026 target of 11.4 billion yen, maximum mass outstanding of 100 billion yen. That is the specific number the FY 2026 target unlocks. By FY 2027 to 2028, as operating profit continues growing, the mass capacity reaches 157 to 228 billion yen. A critical point deserves explicit attention here. As mass accumulates over multiple years, the annual dividend obligation grows. Operating profit must keep pace. This creates a natural pacing mechanism. Metaplanet cannot issue mass faster than its operating profit grows, without eventually breaking the coverage ratio. To sustain 50 billion yen of mass outstanding, Metaplanet needs 4 billion yen in operating profit. To sustain 100 billion yen, it needs 8 billion yen. To sustain 142.5 billion yen, the theoretical ceiling at the FY 2026 target, it needs 11.4 billion yen. The ceiling is always the current year's operating profit at 1 times coverage. Simply, which rule bites first depends on Bitcoin's price and Metaplanet's holdings. With 40,177 Bitcoin on the balance sheet, the picture is instructive. At lower Bitcoin prices and smaller holdings, say 7,800 Bitcoin at $85,000, the 4-to-1 balance sheet ceiling of 24 billion yen is the binding constraint. It is far tighter than the cash flow ceiling of 55 billion yen. But look at the bottom row. With 40,177 Bitcoin at $200,000, the 4-to-1 ceiling reaches 277 billion yen, well above the cash flow ceiling of 140 billion yen. At that point, operating profit becomes the binding rule. With 40,177 Bitcoin at current prices, the cash flow constraint is already the binding rule. What limits mass issuance now is operating profit. The FY 2026 big revenue target is the specific unlock that allows mass to scale to 100 billion yen. Now, let me walk through the complete calculation chain step by step, from operating profit to Bitcoin on the balance sheet. This is the mechanism that converts Metaplanet's operating earnings into permanent, non-dilutive Bitcoin accumulation. Here are 3 scenarios at the FY 2026 target: conservative, base case, and bull case. In the base case, starting with 11.4 billion yen in operating profit. After 30% corporate tax, distributable earnings are approximately 8 billion yen. At 1 times coverage and 8% dividend, that supports 100 billion yen of mass outstanding. 95% of those proceeds are deployed to buy Bitcoin at approximately 100,000 US dollars per Bitcoin. That is approximately 6,552 Bitcoin added to the Treasury. The 4-to-1 balance sheet check passes with significant headroom. Let me walk through each step precisely. Step 1. 11.4 billion yen operating profit from BIG hitting its 16 billion yen revenue target at 71% margin. Step 2. Multiply by 70% after tax. 8 billion yen available for dividends. Step 3. Divide by 8%. 100 billion yen of MARS can be sustainably outstanding and 1 times coverage. Step 4. 100 billion yen of mass proceeds raised from investors. Step 5. 95% of proceeds deployed to buy Bitcoin, 95 billion yen. Step 6. Divided by approximately 14.5 million yen per Bitcoin, approximately 6,552 Bitcoin added to the Treasury. Step 7. Balance sheet check. 100 billion yen of mass against a 4-to-1 ceiling based on 46,729 Bitcoin worth approximately 677 billion yen, ceiling of 169 billion yen. 100 billion is well within the limit. Rule 1 satisfied. The result of hitting the FY 2026 operating profit target. Approximately 6,552 Bitcoin added to Metaplanet's treasury, non-dilutively, without issuing a single new common share, without diluting existing shareholders, and without increasing the share count denominator. Metaplanet held 40,177 Bitcoin as of May 19, 2026. Adding 6,552 Bitcoin represents a 16.3% increase in total Bitcoin holdings, funded entirely by operating earnings, not capital markets activity. This is the fundamental advantage of the operating profit model. Every yen of operating profit earned can service 12.50 yen of mass, which buys Bitcoin. The leverage comes from the dividend structure, not from debt. The calculation chain previously shows a single operating cycle, but the real power of the system emerges when you look at how each cycle feeds the next, creating a self-reinforcing loop that grows larger with every turn. Here is how the flywheel operates. Stage 1. Big earns option premiums. Operating profit grows. Stage 2. Higher operating profit means more Mars dividend capacity at 1 times coverage. Stage 3. More Mars is issued, raising more capital non-dilutively. Stage 4. That capital goes to Bitcoin. 95% of proceeds are deployed to buy BTC. Stage 5. More Bitcoin held means a higher NAV and a higher 4-to-1 balance sheet ceiling. Stage 6. That larger ceiling unlocks even more Mars capacity in the next cycle. Stage 7. 5% of every Mars issuance goes to big as collateral, enlarging the pool. Stage 8. A larger big collateral pool generates more option premiums, meaning higher operating profit in the next year. And then it returns to stage 1, each cycle larger than the last. This flywheel has three independent growth engines operating simultaneously. First, Bitcoin price appreciation. As Bitcoin's price rises, the same holdings are worth more, expanding the 4-to-1 ceiling and allowing more MARs to be outstanding. Second, operating profit growth. As BIG scales its collateral base and revenue, the cash flow ceiling rises, allowing more MARs dividend obligations to be serviced. Third, Bitcoin accumulation. Each Mars issuance buys more Bitcoin, which directly increases both the Treasury and the 4-to-1 ceiling for the next cycle. All three engines compound together. A 50% rise in Bitcoin price does not just make existing holdings more valuable, it expands the balance sheet capacity for more Mars, which buys more Bitcoin, which grows the Treasury further. The compounding is geometric, not arithmetic. How does this compare to Strategy, formerly MicroStrategy, the largest corporate Bitcoin holder globally? Strategy's primary capital allocation tools are preferred equity, common equity, and debt. All of these are dependent on capital markets conditions. Metaplanet is building a fourth engine, operating cash flow from BIG and eventually from Project Nova. This means Metaplanet can accumulate Bitcoin even when capital markets are closed, because the premium income from put options continues regardless of market sentiment. In fact, Bitcoin market stress often increases implied volatility, which increases put option premiums, making big revenue potentially counter cyclical to Bitcoin price. That structural difference makes Metaplanet's accumulation strategy more resilient. The framework I have described so far is entirely dependent on BIG. Project Nova contributes zero operating profit in 2026. It is pre revenue, still building its foundation layer of custody infrastructure, licensing, and product development. From 2027, that changes. In FY 2027, Nova's asset management business produces its first meaningful AUM and fee revenue from Bitcoin income products, securities wrappers, and early managed strategy mandates. Estimated contribution 1 to 3 billion yen in operating profit. Also in FY 2027, Metaplanet Ventures begins generating platform service fees from early portfolio companies, including JBYC and others. Equity exits are unlikely yet, as holdings will be too early in their periods. Estimated contribution zero point 0.5 to 1 billion yen. By FY 2028, Japan's regulatory milestone makes institutional Bitcoin products fully viable. Asset management AUM grows rapidly. Ventures begins realizing early equity gains. The foundation layer, custody and core infrastructure, becomes a licensed billable service. Combined, Nova operating profit target 4 to 8 billion yen. Metaplanet, if it completes its foundation layer ahead of this 2028 milestone, will be the only fully licensed, operationally proven Bitcoin institutional platform in Japan. Here is the combined trajectory when BIG and Nova are both running. FY 2024, 350 million yen. FY 2025, 6.29 billion. FY 2026 target 11.4 billion, all from BIG. FY 2027 14 to 19 billion yen total, as Nova begins contributing 1 to 3 billion. FY 2028 20 to 28 billion yen, at which point Mars capacity reaches 250 to 350 billion yen. At 350 billion yen of Mars, with 95% deployed to Bitcoin purchases at 100,000 US dollars per coin. That is approximately 24,000 Bitcoin purchased per operating cycle. Metaplanet's entire current treasury of 40,177 Bitcoin was built over approximately 2 years of aggressive capital markets activity. The operating profit model at maturity could potentially replicate the accumulation rate through earned income alone. The framework I have described is compelling. It is also not guaranteed. Here are the 3 risks I consider most material in order of near-term probability. Risk 1: volatility compression. This is the highest near-term risk. BIG's yield is directly proportional to Bitcoin's implied volatility. The 33 to 37% annualized yield Metaplanet has achieved assumes Bitcoin implied volatility running at 60 to 80% annualized. This environment has persisted since Bitcoin's institutional adoption accelerated, but it will not last forever. Bitcoin markets tend to mature over time as spot ETFs deepen liquidity, as institutional hedging normalizes the derivatives market. Option premiums will decline. A fall in implied volatility from 70% to 35% roughly halves the yield per yen of collateral. At half the yield, hitting 16 billion yen in big revenue requires doubling the collateral base from approximately 45 billion to 90 billion yen, and doubling the collateral base requires significantly larger capital raises. The mitigant, Metaplanet, can increase BIG's allocation above 5% if yield compresses, and can diversify into covered core strategies on its Bitcoin holdings. But the dependence on volatility is a structural feature that cannot be fully engineered away. Risk 2: the double hit in a Bitcoin bear market. A sustained Bitcoin price decline creates 3 simultaneous problems. First, big revenue compresses as open put positions move in the money and reduce reported revenue even while cash premiums arrive. Second, the 4-to-1 ceiling falls as Bitcoin's market value declines, potentially requiring Metaplanet to reduce Mars outstanding. Third, distributable earnings are impaired because the Bitcoin write-down reduces net income, and under Japanese law, dividends cannot be paid from unrealized losses. All 3 constraints tighten at once, exactly when issuing preferred shares would be most strategically valuable, because Bitcoin is cheapest. The key mitigant is the coverage ratio buffer. At 11.4 billion yen in operating profit, the annual Mars dividend obligation would need to reach 11.4 billion yen before 1 times coverage breaks. At 8%, that requires 142.5 billion yen of Mars already outstanding, a level that takes multiple years to reach. The ramp-up period builds a natural buffer. Risk 3: Mars market reception. Mars preferred shares have not yet been publicly issued. The market may respond differently than expected. Japan's perpetual preferred market has only 5 listed instruments as of late 2025. It is thin. Large-scale issuance may require pricing concessions. If Mars must offer 10 to 12% to attract sufficient buyers, the coverage math changes. At 10%, 8 billion yen post-tax earnings supports 80 billion yen of Mars instead of 100 billion. At 12%, only 66.7 billion yen. The mitigant, The Mercury Class B issuance already completed at the institutional level provides a proof of concept track record. The standard framework for valuing a Bitcoin treasury company is MNAV, the ratio of market capitalization to the net asset value of Bitcoin holdings. Investors pay a premium to NAV because the company's capital markets capabilities allow faster Bitcoin accumulation than direct purchase. But MNAV only captures one layer of value. Metaplanet is building something more complex, a platform with independently valuable operating businesses that deserve their own valuation treatment. Here is the two-layer and soon three-layer valuation framework. Layer 1, Bitcoin NAV at 75,000 US dollars per Bitcoin. 40,177 Bitcoin is worth approximately 482 billion yen. This is the floor, the value the business holds regardless of operating performance. Layer 2, BIG's standalone value at 11.4 billion yen in operating profit, applying a 15 times EV to EBIT multiple, conservative for a high margin, capital light financial services business. BIG alone adds 171 billion yen of enterprise value. This value exists independent of Bitcoin's price. Layer 3, Project Nova, early stage option value. Deliberately wide estimate of 20 to 80 billion yen, reflecting genuine uncertainty. But it is not zero, and it grows every quarter Nova makes progress toward the 2028 regulatory milestone. Total enterprise value in the conservative case, 747 billion yen. In the bull case, over 1 trillion yen. Several observations from this framework. The two layers are not independent. BIG's primary output is more Bitcoin. Its value is not separate from the Bitcoin treasury. It compounds it. Higher BIG earnings, more mass, more Bitcoin, higher NAV, and the multiple applies to a larger asset base. Investors who value Metaplanet purely on MNAV are missing approximately 190 billion yen of potential value from the operating businesses at the FY 2026 target, even before Nova matures. This is the structural argument for a premium MNAV multiple. A company that can self-fund Bitcoin accumulation through operating earnings deserves to trade at a higher multiple than one entirely dependent on capital markets. The premium reflects the compounding value of the operating businesses. It is not irrational. Everything in this analysis is theoretical until two things happen. Mars preferred shares are publicly issued at scale, and Metaplanet's big revenue hits the 16 billion yen target that makes the coverage math work. Neither of those is guaranteed. Mars issuance depends on market reception in a thin Japanese preferred share market. The 16 billion yen revenue target depends on Bitcoin's implied volatility staying elevated and the collateral base growing through continued capital raises. But the blueprint is coherent. The numbers are internally consistent, and the underlying trajectory is one of the most remarkable in contemporary Japanese corporate finance. Operating profit growing from 350 million yen in FY 2024 to a target of 11.4 billion yen in FY 2026, a 32-fold increase in 2 years, funded by a Bitcoin option strategy that did not exist 3 years ago. In 2027, Project Nova begins contributing. In 2028, Japan's regulatory milestone opens the institutional floodgates. If Metaplanet is positioned, licensed, operational, with a proven track record across Big, Mars, and Nova, it will not just be Japan's largest Bitcoin holder. It will be Japan's only fully integrated Bitcoin financial institution. The one number to watch in 2026 is not the net income headline. It is not the Bitcoin price on December 31st. It is whether Big generates 16 billion yen in revenue. If it does, the machine has fuel. The preferred share engine can be lit, and the path to 100,000 Bitcoin becomes structurally funded rather than aspirationally stated. Thank you for watching this video, and I hope you found this information helpful. This analysis reflects my personal research and opinions and is for informational purposes only. It is not financial advice. Markets are inherently risky. Always do your own due diligence and consult a licensed financial advisor before making any investment decisions.